Recorder is going. Okay, so Lululemon unchanged right now pretty much on the day. Earnings are after the close today. Okay. Retail in the last cycle here has really been pretty much a crapshoot in terms of results. And as you can see with the chart I'm about to pull in here, since last earnings, Lulu has actually been pretty flat. Okay, you see last earnings right here, the big gap up. And the stock has really traded sideways for the most part. Yeah, a couple weeks ago, the stock did have a dip, but it came down, if we look here, it came down, and we talked about this the other day, right to this area right here, which had been resistance and had been resistance. So if you go back here in October and you go back here in mid-February, those were points of resistance, which on this drop right here, that old resistance now held as support. Okay, so that price right there is 160, let's call it 161-ish. Okay, if we look at, and you know, Kyle, this goes to your question of which strikes did we choose. If we measure what the expected move is this week on earnings, with the stock trading 171.5, where it is right now, what is the expected move? Okay, so Steve, tell me how you're coming up with 10. Eric, how are you coming up with 8? Because the expected move is around $17, and we're going to go through how we calculate that. But how are you guys coming up with 8 and 10 so I can kind of figure out what you're looking at? Okay, Thinkorswim does not have 8 or 10. Okay. Yes, exactly, Michael. Exactly. Which is really, okay, 14 is closer, but tell me how you're coming up with 14, Steve. And we're looking at the expected move for this week to just expiration on Friday. Because if we do something for earnings, it's really going to be based on the move that's going to happen overnight coming into tomorrow based on earnings. Okay, 17 is the right move, and I'm going to show you how to calculate that here in a moment, but I want to see, Steve, I'm not sure where you see that 14. I'm looking at Thinkorswim here as well. And two things. This is the one-day expected move. It's called their market maker move, MMM. And then this is the move to expiration. And you'll see there's not a big difference because there's only 1 day additional between the market maker move expected number and end of the week. Yeah, so 17 is accurate. Okay, now, without having the ability to, or the capability of looking at the Thinkorswim platform or some other platform that tells us what the expected move is, how would we calculate it on our own? Okay, well, easiest way is to look at the at-the-money straddle for the expiration that we are considering. Well, with stock trading 171.5, there is no 171.5 strike. So what we can do is look at the two straddles surrounding where the stock is. So if we look at the 170 straddle and the 172.5 straddle, okay, the 170 straddle is trading about, what is that, $17.45. The 172.5 straddle is trading about $17.20. So if we add that together and divide by 2, it equals about $17.32, which is almost exactly right in line with what Thinkorswim has from their calculated expected move. So this is the quick and dirty, easy way of calculating an expected move. Okay, so let's get this up on the board here. And can everybody see the whiteboard now? Okay, so the stock equals 171.5. Expected move is about $17, which puts us with an expected range this week of 153.50 up to 188.50. Morning, Rob. How are you, sir? Okay, 153.50 up to 188.50. Now, what we want to do is go back to our charts, and we want to look to see if there's anything in that range that would show any sort of technical reason for the stock to gravitate towards those areas. So the 153.50-ish area, and then that 188 area. Okay, well, we already said that support we were talking about earlier is about 161. If I look down at 153, there's really, there's nothing there. You certainly have the 200-day moving average below that, which will act as support, really big support actually, huge support, around 149. But around that 153 area, there's not much. There is, however, some good support around 161. Okay? Good support around 161, then not until the 200-day moving average down at 149.5-ish. And on the upside, John, what I can do is just give you, I'll post up here the link to my screen, and that will just get you to replicate all the charts and everything that I'm looking at. Let me do that right now. So if I do setup, share, okay, and here is the link. So if you import that link into your Thinkorswim platform, you'll get my setup. Okay, on the upside, there certainly is no resistance up there, right? Because basically the stock would be flying into no man's land. So there may be some resistance up here around 179, 179.5, which is its all-time high, but above that, it's kind of no man's land, okay? Only resistance above is around 179.5, which is its all-time high. Now, looking at this chart, bearish, bullish, neutral, I look at this and I'd say, if anything, I'd be leaning to the bullish side because of the support that it put in here, but more than likely, I'd like a neutral trade. Neutral trade meaning an iron condor, maybe a strangle swap, all depends on volatility and the amount of premium. So let's first look at an iron condor to the expected range area. So down around 153 and up around 188. And if we do that, that thing's trading about $1. Maybe slightly more than that, but it's only trading about $1. So the 155, 152 half, and 187 half, 190 iron condor is only about $1. Not only is that well below the reward to risk that we like, our break evens on that would only be 154 up to 188 and a half. I could live with those break evens if we were getting closer to the 1-to-1 reward to risk that we want, or $1.25. Yeah, Shane, I mentioned that. I mean, the retailers' earnings have been all over the board. Okay, so this iron condor for me, for our money, for what it's worth, I don't love this. Now, at what point would I want to do this? Ideally, we'd want to see $1.25, which would give us 1-to-1 reward to risk. I would probably do this around $1.15. Remember, there's only going to be 2 trading days left in this. Okay? I don't think we would get $1.15. You never know. Maybe we would. But we'll have to check back on that later. Now, let's see what volatility is doing. Okay, and let's see what a strangle swap. Jaitano, are you out here? Because I know you were trying to do one yesterday. No, he's not in here yesterday. He actually pinged me yesterday and was looking to do a strangle swap and wanted my opinion on that. So if we do that, we'd go right to the strikes. We can look at 182 half. We can look at 152 half, and let's go to 190 on the upside. Okay, 152 half and 190. Okay, same place as it was yesterday. I was looking at this yesterday, and it was trading around $1, which it probably is today. Okay, this isn't so bad. This isn't so bad for a strangle swap. Why do I say it's not so bad? I know it's hard to read these charts. Okay, but here's what this would look like with the volatilities, the implied volatilities that we are assuming. Okay, does everybody understand this chart? Okay, so this graph up here is a P&L representation of what you see down below here on the P&L line. Okay, so for instance, this assumption based on the implied volatilities we're using is saying that if the stock remains unchanged, okay, so basically right where it is right now, 171, if we open up, stock is unchanged, we're going to lose 70 cents from the $1.10, whatever it is that we potentially would pay for this. This is not TOS, Steve. This is not TOS. We can do this in TOS on their Analyze tab, and you'll get pretty much the exact same representation. This is called Live Vol, what we're looking at right now. So this 67, 70 cent loss that you see here, corresponds right to this point here. These peaks up here, this 84, 82 cent gain up here corresponds right to here. Okay, this area up here, this gain of around 70 cents up here corresponds right to this here. Thank you, Nancy. Appreciate that. Okay, does that help make a little bit more sense? Okay, so on calendar spreads, which this is, and this is just a double calendar, right? It's a calendar call spread, calendar put spread. On calendar spreads, we like to get 1-to-1 reward to risk. If we're laying out a buck, we'd like to see potential reward of $1 at the expected move ranges. This is lower, however, but that's because we are putting on 2 trades, 2 opportunities. Okay, not 1, 2 opportunities. Call spread, put spread. So this is not bad. This strangle swap is not bad at all. Okay, guys, hang on one sec. I'm going to be right back. Don't go anywhere. All right, sorry about that, everybody. I am back. Sorry about that. So, if we like this type of position where we're looking for a move in either direction, this is actually not so bad. Okay, this is not so bad. Okay, now let's isolate, which we did earlier in the week also. Someone wanted to look at a bullish position. Okay, a bullish call calendar spread. So let's take a look at using the same strike, okay, the 190, and see how that lines up. Okay, that's going to cost about 50 cents. Makes sense, right? If the double calendar or the strangle swap was $1, this should be roughly half of that. This is pretty good. This is pretty good. Okay, let's take a look at the 187.5 to see if that looks any different, any better, different opportunity. Okay, that is going to cost a little bit more. That's probably closer to 55 cents, as well it should be because lower strikes. I think I actually like that better. So, based on how we reviewed interpreting that graph last time that I had up, do you guys understand what this graph looks like? Okay, Pamela, what part don't you understand? Pamela, what part don't you understand? When you say up and down, do you mean this? This is all a graph for this date, June 14th. Okay. Rob, what two signals would you be looking for, and why would we want to put out two signals potentially? Or why wouldn't we want to put out two signals potentially? Yep, David, and what did we calculate as the expected move, if it's to the upside? So that coincides right where we would want it to be, right? Yeah, I wouldn't want to put two trades out there, Rob. Pamela, are you okay with this now? Okay, so Pamela, if we look at the peak up here, okay, the peak up here shows about $1.13, right? Okay, that coincides to that same area right here around 188.35. Likewise, if we looked, let's say right here at 171.22, okay, showing a loss of about, somewhere around 30 cents, which corresponds to right down here. Okay? Okay, so I'm going to look at Lulu a little bit longer here. I would love to revisit the Iron Condor. I also do like the upside reward to risk in the call calendar spread. Okay? IV is very high, Daniel, and we would look to take advantage of that with a call calendar, a put calendar, or an Iron Condor. Okay, Glenn, tell me what sort of butterfly you'd like me to look at. And then Shane, let's take a look at your put spread. So, Shane, you're looking at a $5 wide put spread for $1.50. The area to the downside of the reward to risk that you're targeting, 157.5, that's good. That's right in the sweet spot. However, the reward to risk on that for an earnings play is kind of tight for me. Okay, so Glenn, on your butterfly, that's going to be really cheap. Remember, butterflies inherently are much less expensive trades because you really have to hit the spot right. Okay, so the 185, 7.5, 90 butterfly is only about 20 cents probably. Really cheap. Really, really cheap. Gives you tremendous reward to risk. You usually get about 10 to 1 reward to risk on a butterfly. But also remember, you got to be pretty spot on with where the stock goes. And butterflies typically don't come into full value or close to full value until you get really close to expiration. So tremendous reward to risk on that. Lower probability of it working. Okay, now Glenn, you want to look at a broken wing butterfly. Okay, that's about 85 cents. Very cheap. Definitely more directional. And it's going to be, it's either going to work or it's not going to work, right? Taking more risk because it's directional, but tremendous reward to risk on that. Tremendous reward to risk. It is. It absolutely is, but there's a lot less risk to it because the premium you're laying out is only 50 cents versus the, 80 cents or so that you're laying out on the broken wing butterfly. In addition, the broken wing butterfly is going to work today or it's not going to work, right? Or tomorrow. Whereas with the calendar, you have more time. Okay. All right, so getting back to the whiteboard, the strangle swap is not bad at all. The 187.5 call calendar is nice. What I want to do is go back here real quickly to the first iron condor we had looked at, and let's see what that pricing is, if it has changed at all. And you know what? It's creeping up a little bit. Now it's up to $1.10. We had said earlier, if we could potentially get $1.15, we might be interested. All right, so that's what I'd be leaning towards right now. I want to keep a close eye on Lulu here. I don't want to put this out there quite yet. A little early in the day to put that out. Well, Russell, that's the offer. We're not going to get it on the offer, nor would we get it on the bid at 90. So I'm looking at kind of the midpoint here. If we could get it at $1.25 on the offer, I would sell that as much as we could. All right, so any questions on Lulu, guys? I really like the Iron Condor. If we could get up to $1.15, that's why I want to hold out a little bit longer here. And see where the stock potentially settles in. So not putting out a signal right now, but there could be one coming out. I'm going to keep monitoring this. Awesome, Todd. All right, let me wrap this up then. I will get the whiteboard up here. I will get the video posted in the room. And I'll be right back.